So, so that's a new topic, financial forecasting. Right to see that. This involves determination. This involves determination. This involves determination. This involves determination of financial needs. This involves determination of financial needs of a company, financial needs of a company in advance, financial needs of a company, financial needs of a company in advance, Full stop. Now let's look at importance of financial forecasting. Importance of financial forecasting. Importance of financial forecasting. Yeah. Why should we plan in advance? Now, planning in advance is what we call financial forecasting. It's more of coming up with a budget of the expected income, expected expenditure. Number one, it forces managers to plan in advance, It forces the managers to plan in advance and allocate resources efficiently and allocate the resources efficiently. Full stop. Number two, it's used for motivation purposes. Since managers and other employees are aware of what is expected of them. And number three, okay, it's used for control purpose. I.e., it enhances control of expenses. To avoid wastage during operation. To avoid wastage during the operation. Another importance, number 4. It helps the management to avoid surprises. Which might occur in the course of operation. Which might occur in the course of operation. E.g., cash deficit. Yeah, it helps the management to avoid surprises that may occur. Yeah, e.g., cash deficit. So now let's look at methods of financial forecasting. And in this case, we'll be evaluating two major methods. One is the percentage of sale method. And number 2 is the cash budget. Now let's start with the first one. Percentage of sales method. percentage of sale method. Let me see that. This is a forecasting technique. This is a forecasting technique. This is a forecasting technique used to determine the external financial requirement, used to determine the external financial requirement, used to determine the external financial requirement of the company, external financial requirement of the company in the future, in the future, in the future, in the future. Full stop. We have to see that. This method assumes that, this method assumes that various balance sheet items, various balance sheet items varies as sales varies, varies as sales varies, varies as sales varies, varies as sales varies. Good. So now let's look at steps forward, steps forward, steps forward. What are some of the steps adopted when forecasting using this method? Steps forward. Number one, identify balance sheet items. Identify the balance sheet item. Identify the balance sheet item. Identify the balance sheet item, which varies as sales varies. Identify the balance sheet items, which varies as sales varies. Identify the balance sheet items, which varies as sales varies. So they include, semicolon, first hyphen, which are those items that varies as sales varies. Non-current assets, one is non-current assets. The second one is current assets. The third one is current liabilities. Current liabilities. And lastly, number 4, retained earnings. Retained earnings. Retained earnings. Retained earnings. Good. Yeah, those are balance sheet items which varies as sales varies. Now, current assets, we have the current assets, current liability, and the retained earnings. Step number 2. Step number 2. Step number 2. Express the above items. Express the above items as percentage of sales. Express the above items as percentage of sales. Express the above items as percentage of sales. Number 3. Multiply the percentage of sales. Multiply percentage of sales. Multiply percentage of sales by the incremental sales. By the incremental sales. By the incremental sales. By the incremental sales. Then lastly, number 4. Determine the external financial requirement. Determine the external financial requirement as follows. Determine the external financial requirement. Determine the external financial requirement as follows. So how do we determine the amount of external financial requirements? So we will take the increase in non-current asset when you add the increase in the current assets. Now, if you add the two, you get total financial requirements. Then you deduct increase current liabilities as well as the increase in retained earnings. And that's how you determine the amount of external financial requirement. Ensure that the amount the company they expect to borrow in the coming financial year. Yeah, those are the four steps followed in financial forecasting when using the percentage of sales method. You see that step number one, we need to identify the balance sheet item which varies as sales varies. And those include the non-current assets, the current assets, current liability, and the retained earnings. That's the first step. Then the second step, you express those items as percentage of sales. So that means, for example, if the value of the non-current asset is X, you divide by the value of the sales times 100. That will mean by expressing the above items as percentage of sales. Then the third step, you take the percentage of sales identified in step number 2, and then you multiply by the expected incremental sales. And then lastly, you determine the external financial requirement by taking the increase in assets, that's non-current asset and the current assets. Then you deduct the increase in liability and the retained earnings. And that is the current liability and the increase in retained earnings. So we do a question June 2010. June 2010, question 2B. June 2010, question 2B. The foreign statement of financial position related to Mageuzi Limited as at 31st of December 2009. So we have the fixed assets. For the current asset, we have stock, we have debtors, then we have creditors financed by. There is ordinary share capital, retained earnings, long-term debts. Required. Go to the required. The amount of external financial requirement for the year ended 31st December 2010. So how do we determine the amount of external financial requirement? So determination of external financial requirement. So you see that step number one, we identify the balance sheet items which varies as sales varies, and those will include the non-current assets, of which in this case we have the fixed asset. Also, you factor in the current assets. So for the current assets, we have stock. We have debtors. Also factor in the current liability and retained earnings. So to the current liability, we have the creditors, and then you factor in the retained earnings. That was the first step. And then the second step, you have to express those items as percentage of sales. So for the fixed asset, it was an amount of 13 million, stock 3 million, debtors is 2 million, creditors is 6 million. You express those items apart from the retained earnings. So for the retained earnings, you compute the actual amount. Note number one, additional information number one. Sales in the year ended that 1st December 2009, during that financial year, amounted to 20 million. So during that period, the sales were 20 million. So take this item. Can you stop writing? I'll give you time to write. So you take this item, you divide by the sales for the period, and the sales during that period was 20 million. That's what we mean by express the above items as percentage of sales. Then you multiply by 100%. Now give me that in percentage. The first one is 65%. Yeah, that means that during that financial year, the fixed asset was 65% of the sales. Stock was equivalent to 15% of the sales, and debtors were equivalent to 10% of the sales, creditors were equivalent to 30% of the sales. And then the third step was what? Let's go to the third step. That step, you say that you do what? You take the percentage of sale, you multiply by the increment of sales. Let's go back to note number one. Note number one, to that. Sales in the year ended that 1st of December 2009 amounted to 20 million. The sales for the current year, ending that 1st of December 2010, are expected to increase by 4 million. So the sales are expected to increase by 4 million. So you take the percentage of sales, you multiply by the incremental sales. So the sales is expected to increase by 4 million. What do you get? This is 0.4, this is 0.6, this is 1.2. Sorry? 2.6, good. So now we want to determine the amount of retained earnings. So how do we get the retained earnings? And note number two. The net profit margin and the retention ratio for the year ended 31st of December 2009 were 8% and 30% respectively. So given the net profit margin and the retention ratio, these ratios are expected to be maintained in the foreseeable future. So how much is expected retained earnings? So in short, first of all, I need to determine how much is the expected sales. Now the sales for the period, how much is the sales for the period? The sales for the period was an amount of 20, and then is expected to increase by how much? Expected to increase by 4. So that means the expected sales for the coming period will be an amount of 24. But what we need is the retained earnings. Now this is expected sales. When you take the expected sales, you multiply by the net profit margin, so that we determine how much is the expected profit for the coming period. And we read that note number 2. The net profit margin and the retention ratio for the year ended that 1st December 2009 were 8% and 30%. So the net profit margin is 8%. So of this 24, 8% will represent the net profit. How much is that? $1.92. Now this is the expected profit. But what do we need? We need the retained earnings. So of the profit, what's the retention ratio of that company? Yeah, they retain 30%. So that means of this 1.92, 70% will be distributed as dividend. So they expect to retain 30%. So you multiply by 30%. So how much is expected retained earnings? $0.76. And now we can be able to determine the amount of external financial requirement. This is the amount we expect now to borrow in the coming financial year. How do you get the amount of external financial requirement? You take the increase in asset You minus the increase in current liability as well as increase in retained earnings. So for the creditors liability, you deduct retained earnings is an internal source of fund. So that means for the coming financial year, how much the company expect to borrow? $1.824. So that means for the coming next financial year, the company expects to borrow 1,824,000. Required. Required. The amount of external financial requirement for the year ended that 1st of December 2010, you already have that. Number two, the pro forma statement of financial position as at that 1st December 2010. Pro forma statement of financial position means the forecasted statement of financial position. So for the coming next financial year, so how do we expect to determine this? How will the statement of financial statement look like? So Mageuzi Limited prepare the forecasted statement of financial position as at 31st of December 2010. So our shillings are in millions. So you have the assets. Now for the assets, you just follow what you have. You have the statement of financial position. They have the fixed assets. And the fixed asset was an amount of 13. Then you add, now these are the expected incremental element. Fixed asset is expected to increase by 2.6. So that means it will be an amount of 15.6. Then we have the current assets. So to the current assets, we have stock and debtors. Now the value of stock was 3 million, debtors was 2 million. Then you add the expected incremental element. Stock will increase by 0.6. Debtors will increase by 0.4. So 3.6, 2.4. Then they deducted the current liabilities so that you get the net asset. Current liabilities. For the current liability, we have the creditors. Now, creditors was an amount of 6. And then you add the incremental element of 1.2. And you get an amount of 7.2. Now, give me the net asset. How much will be the net asset? $14.4. And then financed by number one, they had the ordinary share capital. Now, ordinary share capital does not change when sales change. Ordinary share capital only changes as a result of the new issue of share. So that one is not affected by the increase in sale. So the ordinary share capital will remain to be 4. Then there is retained earnings. Now, retained earnings changes as sales changes because sales affect the profit. Profit is what gives rise to retained earnings. So the retained earnings for the period was 6. And then you add the expected incremental retained earnings of 0.576. So the expected retained earnings will be 6.576. And then they had a long-term debt. Now, the long-term debt does not change when the sales changes. We never talked about the changes in current liability. It's only the current liability. So the long-term debt will remain to be 2. But this is what we expect to borrow externally, external financial requirement. This is the amount the company expects to borrow. So that will be part of the debt. So we'll have external financial requirement, which is an amount of 1.824. Now give me the total capital. Sorry? 40.4. Good. Can copy now. Then on current assets, we have current assets, current liability, and retained earnings, correct? So now, since we have the statement of financial position, now let's identify those items. Number one, we have is plant and machinery. Then we have furniture and fittings. Furniture and fittings. Then we have the motor vehicles. Then also we have the current assets, where we have the inventory. Then we have account receivables. And then we have cash at the bank. Then you also factor in the item of the current liabilities. So for the current liabilities, we have account payables. Also, we have accrued expenses. Also, we need to factor in the retained earnings. Good. The amount of plant and machinery was an amount of 31,200. We had 18,720. We had 12,480. We have 19,200. We have 14,400. And then cash at bank is an amount of 3.6. Then account payable is part of the current liability. So we take an amount of 18. And then accrued expenses, we have an amount of 12. Then for retained earnings, we use the actual amount. Good. And then the next step, once you identify those items, the next step, you express them as percentage of sale. So we want to determine, at this financial year of 2015, how much was the value of the sales? Now let's go to additional information. The sales for the year ended that 1st of December 2015 amounted to 120 million. So the sales for that period was 120. So you divide by 120. Then you multiply by 100%. Give me the percentage. Sorry? We have 26%. 15.6. 10.4%. 16%. Sorry? 12%. 3%. Yeah, 15%. Good. So that was expressing those items as percentage of sales. At the end of that step was you multiply the percentage of sales by the expected incremental sales. So how much is the incremental sales? So we read. Number two, the company forecasts that sales will increase by 10% for the year ending that 1st of December 2016. The sales will increase by 10%. So therefore, how much is our expected sales? So our expected sales for the coming year, you take 10% of 120. In short, you add 10% of 12, that is 130. 132. So how much is our incremental sales? So our incremental sales will take 132 minus 120, which is an amount of 12. Or alternatively, you take 10% of the sales, which was 120. 10% of 120, you get an amount of 12. So the expected sales for the coming year will increase by 12 million. So you take the percentage of sales by the incremental sales, which is 12 million. How do you get? Sorry? Get that 120. 1872, 1248, 1920, 1440, 360, 1800, 1200. Then number three. So now you want to determine the amount of retained earnings. So you have the incremental element for the asset and liability. Now I have determined for the retained earnings. So I'll determine for the retained earnings. Number three, what is that? For the year ended that 1st of December 2015, it was during that financial year. After tax profit of the company amounted to 18 million. During that financial year, the profit after tax was 18 million. So we use that information to determine the net profit margin. And how do we get the net profit margin? To get the net profit margin, you take the net profit, you divide by the sales times 100. That's how you get the net profit margin. So that during that financial year, the profit after tax was an amount of 18 million. And how much is the sales during that period? The sales was 120 times 100%. 18 over 120, is it 15%? Then you take that. Let's go to note number 5. Note number 5. The after-tax profit margin is also expected to remain constant each year. So the net profit margin will remain constant. So that means it will still be 15%. So now I want us to determine the retained earnings. How do we get the retained earnings? So to get the retained earnings, you take the actual expected sales, and the expected sales for the coming period is 132. The expected sales is 132 million. Then how much is the net profit margin? Hey, are you following what I'm teaching? So the net profit margin is? So how much is the expected profit after tax? How much is the expected profit after tax for the coming year? Sorry? 19,800. But we don't want the profit after tax. We need the retained earnings. So we need to determine how much is the retention ratio. This is the expected profit, but we want the retained earnings. How to determine the retained earnings? Note number 4. The company adopts 80% payout ratio at its dividend policy. 80% dividend payout ratio. So if you pay 80%, how much do you retain? Good. So of this profit, we expect to retain 20%. And we are told that the payout ratio is expected to remain constant in each year to perpetuity. So how much is that? Sorry? About 960. And then we can be able to determine our external financial requirements. So to determine the external financial requirement, you take the increase in assets, then you deduct increase in liability and the retained earnings. So deduct the increase in liability, 18, 12, and the retained earnings. So how much do you expect to borrow in the next financial year? Sorry? Get an amount of 20? 2,500, Yeah, you get an amount of 20. This was not 70, this was 12, huh? So it's 2,500, right? Then you are told that. Now let's go to note number 6. Note number 6. Note number 6. Assets are expected to vary directly with sales, while account payable and accrued expenses form spontaneous sources of financing. Number 7, any external financing will be affected through a long-term debt finance. So that means any external finance we borrow it externally from long-term sources are required. The amount of external 12% long-term debt financing that would be required for the year ending 31st December 2016. So we already have that. So they need to borrow 2.5 million. Then number 2, a forecast statement of financial position as at 31st of December 2016. A forecast statement of financial position. So this is Georgina. Yeah, a forecasted statement of financial position as at the 31st of December 2016. So shillings are in thousands. So we have the assets. We start with the non-current assets. So to the non-current assets, we have plant and machinery. We also have furniture and fittings. Then we have the motor vehicles. Then we have the current liabilities. So under the current liabilities, we have inventory. We also have account receivables. And then we have cash at bank. So the amount of plant and machinery was 31,200. This was 18,720. What we had was 12,480. Then inventory was an amount of 19,200. Receivables was an amount of 14,400. And then cash was an amount of 36. Then you add the expected incremental element for the coming financial year, and that's what we are computing. So plant and machinery will increase by about 120, 1872, 1248, 1920, 1440, 360. How much is that? That one will be an amount of, is it 34, 320? 1819, 20, 592, 1213, 13,6 or 7, 728, 1920. We get 21, 120, 1415. So 15,840. And this one will be an amount of 39,60. Give me the total assets. Yes? The external financial requirement. Yeah, this is 3,000. Yes? 560. Then we have equity and liabilities. So under the equity and liabilities, we have the ordinary share capital. Now the share capital does not change as sales changes. And for the ordinary share capital, we have it an amount of 42. Then we have the retained profit. And for the retained profit, we have an amount of 17,600. And when you add the incremental retained earnings, amount of 39,60. That one you get, is that 21,560? And what are you getting? 1,560. Then we have the non-current liabilities. So the non-current liabilities, we had a 14% debenture capital. 14% debenture capital. Now, debenture does not change when sales changes, so it remains the amount of 10. Then still under non-current liability. Remember I told that. And you go to note number 7. Note number 7, I told that any external financing will be effected through a long-term debt finance. So we have another long-term debt. Yeah, so external financial requirement, which is an amount of 3. Then lastly, we have the current liabilities. And to the current liabilities, we had account payables. And then we had the accrued expenses. Account payables an amount of 18. This one is an amount of 12. Then you add the incremental element, 1,800, 1,200. So that one will be 19,800. 12, 13, that one will be 13,200. Give me the total. Sorry? 1,156. And copy. Part B of that question. Comment on two weaknesses of the method of forecasting applied in A1 and 2 above. Weaknesses. So now let's look at assumption stroke limitations. Assumptions stroke limitation. Assumptions stroke limitation. And this was current assets, not current liability. I hope you noted that. Assumptions stroke a limitation of percentage of sales method, of percentage of sales method. Yeah, most of the assumption are the limitation because assumption is what it assumes, which is not always the reality. Yeah, so that's why most of the assumption are limitation. Number one, it assumes that the company is operating. It assumes that the company is operating at a full capacity. It assumes that the company is operating at a full capacity. Yeah, that's just an assumption. That's not always the case. The company sometimes might not operate at a full capacity. So that means that assumption becomes a limitation. Number two, it ignores the effect of inflation. It ignores the effect of inflation in the economy. It ignores the effect of inflation in the economy. Number three, it ignores time value of money. It ignores time value of money. It ignores time value of money. Another one, it assumes that the relationship between, the relationship between various balance sheet items, the relationship between various balance sheet items, the relationship between various balance sheet items and sales, various balance sheet items and sales will remain constant, which is not always the case, Yeah, it's an assumption. It assumes that, for example, what you have been doing here, we assume that, for example, this is what it means, that plant machinery represented 26% of the sales. What does that mean? That means also for the coming financial year, when the sales increases, 26% of plant machinery will also increase by 26%, of which that's not the reality. It's not a must that a company in a given year they must acquire new plant machinery. It's not a must they acquire new furniture and fittings. Sometimes even they have to depreciate. But in this case, they are assuming that if sales increases, also those items increases, which is not always the case. Another one, it assumes that the corporate tax, will remain constant during the forecasting period, remain constant during the forecasting period. Now we look at the second rule, that's the cash budget. Cash budget. Right, you see that? And this is a statement showing the sources of cash, statement showing the sources of cash the sources of cash within a specified period, 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 and how this cash will be utilized, and how this cash will be utilized, and how this cash will be utilized within the same period, and how this cash will be utilized within this period, and how this cash will be utilized within this period. Now that's what we call cash budget. It's a statement showing expected inflow, expected outflow, how you're going to get cash and how you're going to utilize that cash within a given period. Let me see that. This statement only recognizes or only records, this statement only records, this statement only records actual cash inflow and outflows, actual cash inflows, actual cash inflows and outflows, actual cash inflows, actual cash inflows and outflows, actual cash inflows and outflows. Full stop. Then I want to say that non-cash items, non-cash items, non-cash items, non-cash items, such as depreciation, non-cash items, such as depreciation, comma, amortization, amortization, impairment, depreciation, amortization, impairment, and provision for bad debt, and provision for bad debt, and provision for bad debt, and provision for bad debt are not recognized in this statement, are not recognized in this statement, are not recognized in this statement. Yeah, it only deals with the actual cash inflow, actual cash outflow. Good. So now let's look at functions of a cash budget. Function of a cash budget. Why should you prepare a budget? Yeah, for example, that this is my expected salary. And then how am I going to spend this salary? That's what we call a cash budget. So what's up there? Do you prepare a budget? Let's start from there. Or you have nothing to budget for? It might be a possibility. Yeah. For those who don't know how to budget. For those who are who rely on their parents, for them they have nothing to budget. At all they have to eat, school fees will be paid, all that. But for those who want, and they are responsible that means they are independent. They pay rent, they pay their own school fees, transport money, all that. For them, they budget. But this is the expected amount. If I receive my salary, this goes to school, this goes to transport, food, all that. So what are the importance of coming up with a budget? Or you don't budget? You budget, eh? Yeah. So what are the advantages? Or why do you budget? Or what's the advantage of having that budget? Sorry? Yeah, it helps to avoid wastage. Yeah, we have those who say that. First of all, once I receive my salary, first of all, I enjoy. What will remain? Now that's what I'll do. What for the other to pay for utility bills, transport, all that. Yeah. One is to avoid wastage, correct? That's right. That's right. One, used for planning purposes, used for planning purposes, used for planning purposes. Yeah, number one is the importance is planning. Number two, helps in coordinating activities, helps in coordinating activities, helps in coordinating activities in the organization, helps in coordinating activities in the organization, coordinating activities in the organization. Another one, controlling of finance in the organization, controlling of finance in the organization. Another one, It guides the management, it guides the management, it guides the management, it guides the management on the undertaking of capital expenditure, on the undertaking of capital, on the undertaking of capital expenditure, on the undertaking of capital expenditure. Another one. It helps to preserve liquidity. It helps to preserve liquidity. It helps to preserve. It helps to preserve liquidity during the period of expenditure. During the period of expenditure. During the period of expenditure. Another one. Another one. It ensures that cash is available. It ensures that cash is available. It ensures that cash is available for revenue expenditure. For revenue expenditure. Yeah, revenue expenditure is what we call the current expenditure. Good. So those are some of the importance of cash budget. Now let's look at ways of financing a cash deficit. Ways of financing a cash deficit. Yeah, as a company, how can you finance a cash deficit? Ways of financing cash deficit. Number one, borrowing. Number one, you can borrowing. Number two, bank overdraft. Another one, issue of shares. The company can decide to issue some shares. Issue of shares. Another one, what are the other ways the company can raise cash? Don't mention what I have said. Don't mention what I have said. I'm not asking about you. Or you can do a fundraising, yeah? So a company, it's like, Casey is doing a fundraising, yeah? You're fine. Fundraising. Okay, for yourself, you can do a fundraising. But as a company, do company do fundraising? They do. But also a church is a company, right? It's an organization, right? Hey, fundraising, eh? I was not expecting that. Yeah, fundraising, eh? We can debate about that. You want to explain? Yeah, correct. Sale of assets. Sale of assets. Again, don't write fundraising. Sasa. Sale of assets. Another one. Issue of debentures. Issue of debentures. Issue of debentures. Issue of debentures. Another one. Buying goods on credit. Buying goods on credit. Yeah, that's why creditors were part of current liability. Does that make sense? Buying goods on credit. Yes. Because, for example, let's assume that you wanted to buy this pen at 100 shillings and you don't have money. So those are various options. You can sell something to get cash to buy this, right? Also, since you want this asset, you can also go and buy it on credit, provided you have it. It's another way of financing. Another one, insisting on cash sales. Insisting on cash sales. Yeah, as a company, you can insist on cash sales so that you improve the liquidity. Now, I want us to do an illustration. May 2017. Question 3A. May 2017, question 3A. Also have another point from the online student. Leasing, can you write that? Leasing. Leasing is another point. Leasing. Sorry? Utilizing? Utilizing retained earnings. Retained earnings is what gives rise to cash. So now that means if you're facing cash deficit, that means you have nothing in your bank account. Yes. May 2017, question 3. Question 3A. The following information related to Soma Enterprise Limited for the 4 months given below. So we have the sales for September, October, November, and December. All sales were made on credit. Half of the debtors are expected to pay within the month of sale and are expected to claim a 2% cash discount. The remaining debtors are expected to pay by the beginning of the following month. Then there is raw material purchases for each month. The firm plans to pay its creditors in full in the month following that of purchase. So that means there is a 1 month credit. Wages and salaries were given that. Added information. All employees are paid in the month in which the wages or salaries are earned. A rent of 10 million for each quarter is paid in March, June, September, and December. Other cash overhead of 2 million per month are payable. A new plant due for delivery in September will be paid in November at a cost of 25 million. On 1st of October, the firm planned to have 10 million in the bank. Required a cash budget for the 3 months ending December. A cash budget. So how do we prepare that? So we start with the working. Kindly avoid copying when I'm teaching. So you have the month of September, October, November, and December. We'll start with the sales. Now, the sales, you do that. We're given the sales for each month. All sales will be made on credit. Half of the debtors are expected to pay within the month of sale and are expected to claim a 2% cash discount. So, within the month, 50%. So 50% are expected to pay within the month. And in that case, since they pay, that's what we call the cash discount, they expect to claim a 2% discount. So how much will you receive in September? So it's 30, 35, and we have 90. But what we need is the actual cash receipt. So how much was the cash receipt? Now, of this 30, what they expect to pay half, they are going to pay only 98% because they are claiming a 2% discount. So you take 98% of that. This one will get 29 point. 29.4. How do you want to get that point? 34 point? This one you get? So was it 90 or 45? This was 45, right? You get an amount of 44.1. 44.1. 44.1. So remember 50% we are paying within the month. What about the other? The remaining debtors are expected to pay by the beginning of the following month. So 1 month credit. The remaining 50%. This is very simple. Now the sale for September was an amount of 60. Half they pay within the month. Then the remaining 50% they pay the following month. So gosh, how much do you expect here? But then for the October they pay, then this 35 they pay, and then the other 45 they pay in January. Simple. Then we have also raw material purchases. How do we pay our creditors? So payment for raw material. This one is very simple, because we are told that the fund plans to pay its creditors in full in the month following that of purchase, following the month of the purchase. So that means all they purchase in September, the amount will be paid in October. So which is an amount of 20, the other one will be 40, the other one will be 40, and the other one is that, yeah, that goes now to January. I think I have everything I need. So now we can answer the question. What was the question? A cash budget for 3 months ending December, 3 months. So this is Suma Enterprise. And so cash budget for the months of, so we just need for 3 months, October, November, December. We start with the inflows. Now for the inflows, we have the sales, the cash received within the month. So within the month, and then 1 month credit. And note that this cash budget leads to the actual cash outflow for that period. So we just need from October to December. Now for the sales, for the first 50%, we receive net of discount. So this is the cash received or receivable. So October will be an amount of 29.4, November an amount of 34.3, December 44.1. The 1 month credit in October you receive 30, November 30, December 35. So it's 30, 30, 35. There is no other income. So now give me the total inflows. It's going to get an amount of 59.4, 64.3, and 79.1. Then we have the outflows. For the outflows, there is payment for raw material or payment to creditors. So payment for raw materials. So the payment for the raw material October is 20, November 40, December 40. So it's 20, 40, 40. And then we had wages and salaries. Salaries and wages. Note number 1. In note number 1, you're told that all employees are paid in the month in which the wages or salaries is. And so that means for October, it will be paid in October. How much was for October? 15. November, it's an amount of 17. And then we have 13. Note number 2. Note number 2. A rent of 10 million for each quarter is paid in March, June, September, and December. So there is payment of rent. Payable each quarter. So when you do December, good. December, you pay an amount of 10. Number 3, other cash overhead of 2 million per month are payable. We have cash overheads, 2 million per month. Number 4, a new plant due for delivery in September will be paid in November at a cost of 25. So new plant. And you're told that the new plant due for delivery in September will be paid in November. So when will the actual cash outflow happen? November, correct. An amount of 25. So now give me the total. So you get the total outflow. 20, that is it, that 7? 40, 50, 60, 70, 80. You get 84? 40, 50, 60. You got 65? Good. Then now we can get the net cash flows. How to get the net cash flow? You take the inflow for the month, you minus the outflow for the month. So you can call it A, and this one can be our B. This one is how much? Point number? Additional information. We'll come to that. Yes. So now I'll give you the net cash flow. October, the store inflow was 59.4. The outflow was 37. How much is the net cash flow? 22 point? November, 64.3 and 84 get negative? 19 point? 70, and that is it 14.1? Then we add cash. Balance brought down so that now we can have cash and cash equivalent balance at the end. And how do we determine that? Note number 5. In October, sorry, on 1st of October, that's the beginning of October, the first month. So on 1st of October, the firm plans to have 10 million in the bank. So the firm, at the beginning, they had how much? 10. They expect to have 10. That's the balance brought down. And then during the year, there was a net cash inflow of 22.4. So how much would be the closing balance in the account? That's 2 point. Now the balance carried down for October becomes the opening balance for November. So the balance brought down will be that 2.4. And then during the year, there was a deficit of 19.7. So how much will we be having at the end? 12 point. The balance carried down for the month of November will be opening balance for December. So you'll have an amount of 12.7 and you get an amount of 26 point. Simple. Now you can copy, and that marks the end of that topic.